Teacher Kate from Riru has been waiting years for this moment. Today, her affordable housing allocation letter finally arrived, but the celebration is quickly overshadowed by what comes with it. The Tenant Purchase Scheme agreement is a dense, 25-page legal document packed with a kind of heavy, legislative jargon that seems to require a law degree to decipher. A signature on this page legally binds Kate to a specific financial reality for the next 25 years. We are going to translate this document. We'll strip away the dense clauses and turn them into an actionable, real-world map of her financial future. The foundational math of this contract starts with a simple equation. The total cost of the housing unit, minus the mandatory deposit, leaves the principal loan amount. This chart shows how a reducing balance loan works over a 25-year timeline. As the principal amount shrinks month by month, the interest you owe decreases right alongside it. You are only charged interest on the remaining debt, not the original total. The speed at which that balance reduces depends on your income bracket. The law defines specific tiers. Social housing interest rates are capped at 3%, while market units can go as high as 9%. Identifying your exact tier and mapping out that reducing balance trajectory is the only way a buyer can accurately forecast their lifelong housing costs. The baseline monthly payment is only part of the story. Regulation 5.2 mandates that the buyer pay the premiums for a group life insurance cover to protect the state's asset if the buyer passes away. The contract also includes recurring operational costs, binding the buyer to monthly service charges, municipal rates, and estate maintenance fees. When Kate adds these insurance and maintenance fees to her loan repayment, her actual monthly output increases significantly compared to her current rent. The advertised price of the housing scheme is rarely the final monthly budget required to maintain the home. Fortunately, the contract triggers financial perks in wider laws, specifically the stamp duty exemption for first-time affordable homebuyers. There is also an income tax relief tied to the affordable housing levy, where contributors can claim back 15% of their contribution. This relief is capped at 108,000 shillings per year. The government does not apply this automatically. The buyer must actively claim it through their tax returns. Failing to look past the housing contract into the wider tax laws means leaving thousands of shillings on the table that could be used to offset the hidden costs of ownership. The contract also outlines what happens if the math fails. If a buyer struggles to pay, the law allows them to downsize to a cheaper available unit, rather than facing immediate eviction. However, if a default continues, the legally mandated timeline is strict. A 30-day notice is followed by a 14-day repossession window. Even after the house is completely paid off, Section 31(1) of the regulations prohibits the free sale of the house for 8 years after the final payment. Bypassing this restriction requires explicit consent from the Affordable Housing Board and a formal evaluation by a registered valuer. Signing this agreement requires sacrificing total liquidity and control over your largest asset for nearly a decade after the debt is cleared. Kate is back at her table. The 25 pages are still there, but the technical breakdown has turned those intimidating clauses into a list of specific rules she can now track. First, take the full 7 days allowed for review. Manually verify that your specific interest rate, loan tenure, and monthly payment match your legally assigned tier. Second, log into iTax and file for your stamp duty exemption and the 15% tax relief to reclaim your entitled cash. Finally, verify the underlying project title before signing. Because an individual title is only issued upon completion, the foundational land must be legally clear of disputes. With the math checked and the risks understood, Kate puts her pen to the paper. She is legally bound to pay. But what happens if the government stalls on actually building the house? We'll explore that next time in Following the Corridor.